a very warm welcome to Ratnakar sir from Hyderabad Angels. His profile and the LinkedIn was all already sent to you, so I won't spend too much time giving a very formal introduction. But just wanted to mention why we kind of thought that it is, would be really helpful to have an expert kind of, share his thoughts on how ESOPs can really help create value for the startups. So one, Ratnakar sir has been with Hyderabad Angels for quite some time, and as his profile mentioned, has been responsible for fairly successful exits from the startups. But during the conversation with him, two things were very clear. One, of course, was his intent of truly helping startups, right? And it doesn't matter what stage and regardless of whether they were, truly looking for investments at that stage or not, his intent was to kind of help startups and kind of clarify the path forward for them, right? So that was kind of, very clear from the conversation with him. And secondly, as we were discussing, he did mention how ESOPs can play a very critical role in, not just building teams. Of course, that is something that many of us know, and it's clear from some of the questions that people have asked that in terms of building the team, in terms of employee retention, how helpful is ESOP. But he also gave examples of how this can actually help create more value for the startup. And I think I will leave it to Ratnakar sir to kind of give those details. But I think it's important for those, even if you may not have a sense of whether you want to create an ESOP or you want to do it a little later in your startup journey, it's important to know what exactly ESOP structure is, how does it kind of help the overall functioning of your business. And therefore, we thought a good conversation around this topic will be helpful. Of course, as I've always said, a CEO roundtable is supposed to be an open forum wherein you can discuss any other aspects if you want to. Sir has been kind enough to kind of give us an hour. So certainly the key topic of discussion today would be ESOP, but anything that you would like to kind of, share your experience or anything, please, this is the forum for that. So with that, Ratnakar sir, over to you. And thank you once again, sir, for offering to be part of this session today.
Thank you. Thank you, Jaya, for entire this thing, what you said. And good afternoon, guys. I think a few of the people have joined and few may join. We had multiple conversations with Jaya, and I also been with startup ecosystem for last 4.5 years. And one of the critical thing which we observed startup to succeed is having the right team. Now, what is right team is always a question, but in order to attract a right talent, which will help startup to scale faster, they need different kinds of people because many of the startup founders have never seen this kind of large scale expansion what we are seeing today in a shortest period. Because all the traditional entrepreneurs who has been either in Hyderabad or Chennai, they build a 100 crores company over a period of 10 to 12 years, step by step, brick by brick. They used to grow. Now the startups have changed that version altogether. They said we can grow a 100 crores company in less than 18 months to 24 months. So here the team plays a key important role. And every startup founder has a challenge in attracting these key people because the availability of the cash is always a crunch. Cash is the resource. So they look at other avenues of attracting this talent, which we are calling as employee stock option plan. That is called ESOPs. So how many startup founders have successfully implemented these ESOPs and brought the right people on the platform and able to grow? And how ESOPs can bring value both to organization and also to employees who are part of this startup journey. A senior level executives are willing to resign their fat paying jobs wanted to join the startup to look at their passion, and they are also looking at in this startup journey. So taking these few points, I want every person who is part of this conversation understand why ESOPs are important. I have certain questions which I try to cover through my presentation today. And any further questions, I am very open. You can raise it. I will be able to address to the extent possible based on my experience. And I also, in my previous organization, I got ESOPs. I bought it. I am also an owner, though I exited, still I hold shares in that company. So, what is ESOP? Why ESOPs? As I said, attract, reward, motivate, and retain employees. Somebody wanted to speak? Yeah, thank you. Why ESOPs need to be given? As I discussed, it is to attract, reward, motivate, and retain employees. Please understand, it is more to keep these employees for long term, and they are getting benefited in the growth story of our organizations. Second is once we are all successful, along with the founder, his value of his shares will also go up, and it gives tremendous job satisfaction as being part of the growth story. And third, for the founders, it is a deferred compensation strategy because, for example, today I am dealing with, as I was explaining to Jaya other day, a large life sciences company. We looked at what are the strengths and what are the weaknesses. What we understand, founder never seen how to make a 10 crores company into a 1,000 crores company. And we identify a CEO of a large organization to come and join us. But his salary was around 2 crores per annum. And today, based on the cash what we have, looking into future growth, we cannot offer more than 72 lakhs per annum. The question came for both of us. What is that we need to do to make him satisfied that he is making enough money, his taxation is minimal, and he is also getting benefited through ownership in the organization. So what we did is we made him agree for 72 lakhs where we did some tax structuring where he gets enough cash in hand. We also given a commission percentage on growth of sales. For example, they need to grow from 10 crores to 100 crores. We allotted a certain percentage of the revenue as this compensation. And third thing is, we also given, if he is going to hit 100 crores and above, employee stock purchase plan. And on top of it, because we are raising funds on reaching 50 crores revenue from a private equity investor, and ESOP plan has been granted with certain milestone what he need to achieve. So this has satisfied him that over a period of next 5 years, he would be drawing more than 14 to 15 crores in terms of ESOP, employee stock purchase plan, commission, and his fixed salary. So we were able to attract that person. Why I given that example is this deferred compensation strategy is very, very important when you're attracting a high level talent who has run large organization. As you said, paying taxes to government, it is good for the country, may not be good for the individual. That's why employee stock purchase plan also makes a good retirement benefit plan for them. And ESOPs are given who aligns with the company goal. The company goal is to grow organization ethically with a lot of governance and see that the scale is going up. This is what we are looking when you are looking at the ESOPs. From the founder perspective, what is the key thing? When you're deciding on the ESOP, you need to form a core team. Who is your core team today? And for that core team to retain for a longer time, why you want to give an ESOP? So I have another example where the organization did well for 5 years. Now they wanted to scale much faster. Before raising the fund, he decided who will be the part of the core team. I always say to the business owner, your decisions cannot be emotionally connected. I see many founders are emotionally connected to the people. I say your decision should be connected to the desired goal of the organization, who has that capability to achieve. And for them only, you need to form a core team and give the ESOP with the required milestone. But if you're emotionally connected and trying to give shares, for example, a company which is valuing around 250 crores, if they're giving 0.5% stake to a person who may be closely, he may be very close to you, but he may not helping the organization for the growth. If you're giving even a 0.5% of the share, you're giving away to the extent of 1.25 crores to that guy. Just think about it, and a lot of VCs don't like it if they're not performing. Incentivizing top performance is the key option and the key benefit what we are looking for the ESOP. And by doing both of them, we are instilling a sense of ownership in employees. Please understand that actually very clearly on that side. What companies sees on granting ESOP? Loyalty, performance, designation, present and potential contribution, and opportunity cost. These are the key things what as a founder, what as a company, what as a VC somebody is investing in the company, it looks at ESOP granting to an employee. Yeah. So taking this at a high level, though a lot of people know what is ESOP, how it plays an important role, I want to spend 10-15 minutes on that just to reminisce our current understanding of ESOP so that we are all intact. What is ESOP? In Indian perspective, employee stock option plan. In US perspective, employee stock ownership plan. So US, they call it as employee stock ownership. In India, they're calling it as a stock option plan. What is stock option? Why we call it as a stock option today? Stock option is the right given to employee to buy certain number of shares of the company at a fixed price over a period of time. That's why we are calling it as a stock option. I think if many of your friends are working for Microsoft, Google, Salesforce, they're getting ESOPs by way of restrictive stock units. They call it as RSUs. Why they call it as RSU? They call it as employee stock ownership plan. They wanted to give the ownership. Here, what we are telling is, because of our law of the land, we call it as stock option. Stock option is the right given to employee. It is a right given to employee to buy certain number of shares of the company at a fixed predetermined price over a period of time. So this is a change in both of our culture because we want employee to earn shares and buy the shares at a predetermined price. There are three main characteristics. The number of shares can be brought, the number of shares that can be brought is predetermined. Though we say percentage today, the number of shares are predetermined, what he can buy. The price at which shares can be brought is also predetermined. The right is available over a period of time. Even that is predetermined. We cannot carry. I'll give you an example. There are many instances which came in newspaper. An employee worked for 2 years. Based on the ESOP plan, he got certain rights to purchase a share. As per the agreement, please understand, ESOP is also a contractual agreement as per the Contract Act. As per the agreement, in case of termination of the employee, he need to buy the shares within a period of 30 to 60 days. A lot of people are putting that conditions. If he doesn't buy the shares at a predetermined price fixed by the company, all the shares which has been vested to him will get cancelled. And this has become a huge furore across industry and cursing a lot of startup founders. I see many of the employees are not reading this condition very rigorously. So our law of the land clearly said the number of shares that can be brought is predetermined. The price at which shares can be brought is also predetermined. The right is available over a period of time. It is not indefinite right for any employee. It has certain When it will be indefinite, as long as he's there in the company. But when he is getting terminated for whatever reason, the right will have certain period of time which they need to avail. So this is what they call it as company grants options. Again, I told you, in US it is called employee ownership. In India, it is called employee stock option. So there is a grant price or excess at the price at which shares are offered to employees. A lot of people ask me, Ratnakar, can we offer shares at face value of rupees 10? I said, yes, you can offer, but Income Tax Act and Companies Act, FEMA, Foreign Exchange Management Act, and RBI clearly said when you are giving an option, when you're deciding your ESOP pool, and when you are giving that grant to the employee, you need to arrive at fair market value, FMV. I don't know why they defined it. This is troubling many startups. They said you define a fair market value. For example, your fair market value is 200 rupees. You need to give ESOP grant option at 200 rupees today. Second is vesting period, the period after which the option can be converted into shares. Generally, ESOP was given for retention of employees. Please remember, it is not as a compensation. A lot of founders are confused between compensation and retention, but we are giving ESOPs along. As I said in the example number one, a 2 crore salary coming at 72 lakhs. That's why I given commission, I given employee stock purchase plan, then I given ESOP on top of it. ESOP has been given for retention of the employee for the long term. So they expected employee to stay for 2 years or 4 years. If it is 2 years, 50% every year. It is 4 years, it is 25% every year. You can define. Or it is 3 years, 33, 33, 33. You can define on completion of each financial year. ESOPs are also subject to attainment of the milestones. In my previous company, my CEO got a milestone of reaching $100 million. He has reached only $97 million. He lost his ESOP option because he is not able to attain the desired objective of the company. He came and fought with the board, but board clearly said you are given a milestone-based employee stock option. You are not attained milestone, we will not be able to grant the ESOP. The old ESOPs has been cancelled. We will give the new ESOPs today. Understood? No, there is a vesting period. Vesting period can be accelerated? Ratnakar sir, originally we thought we will give this vesting period over a period of 4 years, but can I reduce it for 2 years? As it can be done with the approval of the board. On certain conditions, depending on that particular day case. Okay. When you vest the shares on completion of that particular milestone or a period, somebody, can you put it on mute? Thank you. Thank you. So when the shares are getting vested, that doesn't mean employee has the right to purchase the share. As I said, stock option is, it is a right to purchase the shares. Vesting means, for example, I given 300 shares over a period of 3 years, 100 shares at the completion of 1 year, 100 shares at the completion of second year, 100 shares. So on completion of first year, I am eligible to buy as an employee 100 shares from you at a fair market value determined is example 200 rupees. When I buy that 100 shares at 200 rupees, then it is called exercise. This is called the exercise period. You understood now? Most of the companies, they give option to employees to exercise vested option when they are staying in the company at the time of buyback or sale of exercise options is what they do. This is what most of them will do. People who need to buy early is people who get terminated, people who don't want to stay longer, but they wanted to avail the benefit. They need to buy within 30 days or 60 days as per the exercised option today. Okay. How does employee benefit? See, my share price stood at 150 rupees over a period of 3 years, but the company share price went from 150 to 500 rupees. This is the benefit for share which he will gain, because he is also a party for growth in share value. Today, in startup ecosystem, many of the startups are raising funds in less than 30 months. Some are raising in 12 months, some are raising in 18 months, some are raising, they're doing Series A, Series B, Series C. They're all getting benefited because the share price is increasing. Understood? So they get benefited, but this fair market value is not going to change. Now the question will come back, Ratnakar, can I give the shares at fair value of 10 rupees? When I give the share price at 10 rupees, at any point of time, 10 rupees minus this 150 rupees, what you are saying, the fair market value, 140 rupees is already deemed as a income for that employee, and you need to pay the tax. You need to show it in Form 16. This is the law of the income tax rule, and most of them will get affected. And once he decide to give that ESOPs at 10 rupees, for example, they put aside 10,000 shares into 140 rupees, that will hit your P&L immediately as an expenditure. And you need to pay the TDS provision on that particular shares. Most of the companies don't have money to pay, especially in unlisted entities. I said, why you need to go? Today you decided your company share price at 150 rupees. Let us go and execute the same transaction. Because employees will exercise when you are doing a buyback. Somebody is taking over the company under M&A, or an incoming VC investor who is putting a large fund wanted to acquire the shares. They have an option to sell the shares at that price. They will make the gain. They don't need to bring that cash at that point of time. There are two ways of implementing ESOPs, direct route and trust route. Most of the ESOPs are top up to existing shares, number of shares. They are not part of existing shares. That is called the direct route. Company will set aside certain number of shares. It will give the letters to the employees and it will be executed. This is a plain direct route. In a lot of other cases, what we observed is, since VC or sometimes investors don't allow to create additional pool of shares, as it dilute the stake for the VCs, promoters have decided to keep certain portion of their shares under ESOP pool. When they're transferring the shares from them, where do they transfer? They will ask you to transfer through a trust route where employee welfare trust will be created. Okay, the shares will be transferred. Company will grant a loan for subscription of the shares and they will keep it over here. This is allowable as per the Income Tax Act. And the promoter will be taxed because he's giving shares either at fair market value or lower value, you have the tax component. And when employees are exercising the shares, he will transfer money, and the said money will be whatever need to be repaid, we will repay back to the company, and balance will be taxed in employee welfare trust if they are making additional money over there. So this is possible when existing shares of the promoter or a founder is getting moved. This is the best route to avoid taxation. There are many rules are there from the income tax point of view, how taxation can be managed through the trust route. Regulatory framework, Unlisted Companies, Companies Act 2013, Income Tax Employee Stock Option Plan. What RBI and FEMA has said is, you can give overall employee stock option plan restricted to 5% of the company shares. Above 5%, you cannot give for the employees who are outside India, because many of our software companies like Zoho or Freshworks and a lot of other companies have set up their offices in US, and they're given the ESOPs initially for the US guys also to exercise. And for them, this FEMA and RBI regulations will come in play. Listed companies, SEBI guidelines and other things will play an important role. How ESOPs will be granted? As per Companies Act, shareholders' approval is needed by passing a special resolution. a separate resolution for grant to subsidiary or holding company employees or identified employees equal to or greater than 1% of the issued capital. So they need to pass a resolution for each one of these grants. A special resolution also need to be passed in the AGM, annual general meeting, or EGM, extraordinary general meeting. And in this meeting, you need to have pricing in place where we are saying fair market value and lock-in period. Whether you want to lock for 3 years, 4 years, 2 years, you need to decide. And accounting for ESOPs will be done as per accounting standard and ICAI guidance note. In FEMA, other than ESOP, you can also issue options under cashless employee stock option scheme. Does not involve any remittance from India. This we can plan as a tax strategy and planning to give shares to employees who are outside India today. Okay, that can be done. So taxation, as I said, vesting period, no tax, exercise period when they purchase shares. Here now, surprisingly, income tax has came with a provision. For example, the share price is 150 rupees a year. At the time of exercisation of the share price, means employee is purchasing a price at 150. On the day, the price of the share is 500 rupees. 150 minus 500 on 350 rupees, there is a progressive taxation which we need to recover from the employee. And if they are selling the share at 600 rupees, 600 minus 500 is the taxation you'll get. But here you don't exercise from vested to directly selling, then 150 minus 600 will come as a price for it. Lot of companies in India are allowing them to take the cash at that point of selling instead of buying the ESOP and selling it. They're giving that option. Some of the companies in India has did that actually. For employees, in the hands of employee, at the time of allotment, taxable value is equal to fair market value on date of exercise of the option minus exercise price. At the time of transfer, taxable value is equal to sale price of value of the share minus fair market of share at the time of exercise. This is a simple math. This information need to be given to employees. Many were surprised when ESOPs are getting exercised and company valuation has gone up and they wanted to exercise the shares. They got hit very hard on this side. Sir, if employee doesn't want to pay 150 rupees for my share, what is the best option? Increase his salary, pay TDS, and show as salary payable or bonus payable. Against payable, you can still issue shares to the employees. Then it is called not called as employee stock option. It is called as employee stock purchase plan. Instead of taking salary and cash, is buying shares from the company. That also we can do that actually. So I'm giving you an example just now what I said. This is how it will apply. RBI reporting in case of non-resident. If options are granted to any non-resident employee, then company need to submit ESOP form on SMS portal within 30 days of grant of option. Company also need to submit ESOP form on SMS within 30 days of issue of shares on exercise offer. So 2 times at the time of grant, at the time of exercise, they need to update in RBI portal that ESOPs has been granted. This I want many of the startup founders to be aware when they're giving ESOPs outside India. So I spoken about stock purchase plan. These are the companies which has allowed their employees to purchase shares at a discounted price, which has done is Havells, Mindtree, Jindal Steel and Power. It is possible, but in startup world, employee stock purchase plans are not common, but I wanted to give this opportunity to look at it. Restricted stock units, as I inform, this is what most commonly US companies are doing, like Salesforce, Infosys, Wipro. A lot of people are doing this now. I've seen in Hyderabad also, Broadreach and large companies are following restricted stock unit opportunities. These are the shares which are issued outside India. These are not applicable to the shares which are issued in India. actually. Infosys and Wipro has American depository receipt, they call it as ADRs, which are listed in NASDAQ exchange, and they're giving these shares to those employees who are critical for them, which is similar. So here the underlying condition is target by revenue, performance based, etc. If condition fulfilled. Stock appreciation rights. This is the new one which is coming in the market, where people started giving that appreciation by way of cash instead of buying the shares. So they're giving a letter. So for example, today the fair market value is 150. After 2 years, the fair market value goes to, today the fair market value is 10. After 1 year, it goes to 100 rupees. Either you can buy the share or I'll give you the cash for 90 rupees. So these are the companies, they are doing the different ways of attracting employees, what they are trying to do now. Who are the employees who are covered under ESOP plan, who are not covered under ESOP plan? So you all know permanent employees, whole-time directors, non-executive, non-promoter directors of its company, holding and subsidiary plus foreign employees. Not covered, contractual employees, independent directors, directors holding more than 10% capital, employees or director related to promoter group. Please understand, if you define yourself as a promoter in the agreement, you are not eligible for ESOP. Or if any of the directors holding, whole-time directors holding more than 10% capital, they are not eligible for ESOP. Even independent directors are not eligible because independent directors are not allowed to hold any shares. So as I said, holding covered, company covered, subsidiary company covered, associated, joint venture, and group company, if any, cannot be covered under ESOP plan. So there were certain questions which I received from Jaya ma'am, which I would like to address few of them here. How a ESOP pool can be used for planned growth of the organization. We felt when startup ecosystem started around 15 years back, somewhere in 2006, ESOPs, which are not very common across India, will increase its presence. Now ESOP has become very, very common. I think initially a lot of IT companies used to give. And one of the key theses I was telling to many people is why Bangalore has become capital for VC world and capital for startup ecosystem. Today, Bangalore, Delhi, and Mumbai contribute 92% of the capital which comes to startups. And Bangalore is a clear leader in funding the startups. I think most of you agree. The reason is in 1994, 1995, when Infosys came into the stock market, Microsoft and all of the company, they encourage ESOPs to their employees. All those employees in Bangalore has richly gained because of the ESOP pool. They made money and they started believing investment in startups and ESOP pools will definitely grow the company, and that money what they gained over a period of time, they started investing back in startups, and Bangalore clearly taken a positive road in investment in startups for last 1 decade. Bangalore is still number one in terms of startup funding today and number of startups growing over there. That ecosystem has definitely grown much, much, much faster compared to Hyderabad and Chennai. In Hyderabad and Chennai, I observed many companies have not given ESOPs. They are not able to make enough money to invest back into the startup ecosystem. So, so ESOPs have definitely played a big role. So founders leverage ESOP as an employee retention tool. Employees see this equity option as a wealth multiplier. Employee stock option plan is essentially a long-term incentive. Please tell employees, people stay for 1 year, I got ESOP plan, I wanted to go, is not that the purpose for which ESOPs has been given. It is long-term in incentive. I always believe we are born in this earth to see good and bad in our life. So in our path to journey, one day we'll be sad, one day we'll be happy, one day we'll be moderate. In the startup world also, someday we'll be doing well, someday we'll be having a bad time. And employees who are leaving us in the bad time, not believing the long-term story of the founder, until unless the founder is really bad, the ESOP doesn't hold any value. That's why we said ESOP is essentially long-term incentive that is granted to employee to buy or subscribe to the shares of the company at a predetermined of price. Yeah. So here I will stop it. There were a few questions before I go ahead because I've spoken a lot for the last 20, 30 minutes. I want people to ask any questions, and I have few questions which I need to address. I'll address in coming slides in another 10, 15 minutes. I'm open for the questions now. Anybody has any questions?
If you have any questions, I request you to put it on the chat so I can. Thank you so much, Ratnakar sir. I think it was a very comprehensive, understanding of ESOPs that you've covered in this session. And most of the questions that Jaya ma'am had written to you has been addressed by you. Let's just wait for a couple of seconds to see if there are any additional questions from the startups.
I received few more questions. I'll address in the other points.
Okay.
Let me do. I'll continue so that people will come.
So there's somebody who's written, what is the cost of issuing and maintaining ESOP?
Okay. No, there is no cost majorly involved. Generally, what happens is, if you are increasing the ESOP pool, there is a fees for ROC, and your company secretary will charge a certain money. And it is a regular share issuance thing which we do. I don't think it is a major price point which will hit a company to a larger extent. It is a small amount of money, but the impact is long term.
Understood. And we have few follow-up questions. What is the typical timeline in months for a small startup which is under 10 people to build a ESOP plan?
For 10 people ESOP plan, yes, I do agree. You can do it immediately on starting the company and formulating. See, generally in startup world, we look at ideation stage, then we look at minimum viable product, then we look for customer acquisition plan. When ESOPs will be granted is when you're going into the customer acquisition and looking for friends and family round, which is coming in play. I don't want somebody who's in ideation stage thinking about ESOP. It is not worthwhile discussion at that point, because you yourself doesn't know whether the idea will turn into a possible synergy for you to grow in the long term.
Understood, sir. So the next question is also on similar lines. So since it's answered, I believe we can skip to the next section that you would want to talk about.
How different is sweat equity from ESOP? There is one question from Priya Venkat, who was sent directly to me. Sweat equity is the one which goes to the person who has created an IP, or a person who created a knowledge, or a person who created the organization to the next level. Generally, sweat equity goes to the promoters, founders, and the key person who created an IP for the company. And it should be decided by the board, and certain percentage of the shares can be given as sweat equity shares based on the value proposition, what we are looking at to acquire that IP or to give a compensation. Sweat equity comes almost at later stage only. Almost when the company 100 crores or 1,000 crores and getting listed, and they wanted to take some benefit of their contribution which has been happened to the company, at the time the sweat equity will come. In the startup world, generally we As investors, we don't encourage to take founders for a sweat equity, because the stage at which most of the people will enter, they don't like to do that. Thank you. So few questions has come to me. When do I plan my ESOP pool? Most of the people, both in VC world or people who look at startup, we want ESOPs to be created at early stage when they're raising seed money or they're raising the angel rounds. In most of my cases, ESOP pool we will generate when we are putting the money. Hyderabad Angels or Mumbai Angels or Chennai Angels, some Angels is putting in money. We are insisting him to create an aggressive ESOP play, because from there the growth journey will come. See, initial stage is a seed stage. They are not planning for growth. They are planning for and their idea to be seen into the reality. There I don't see the ESOP play is an important tool. But when the plan gets into reality and the company is growing, it is going to take a takeoff. Like Flight wanted to take off, the growth wanted to take off by bringing money from the seed and angel investors. At that time, you need to create a ESOP. You know you are getting into the game of growth, the game of customer acquisition. There you need more amount of effort. There you need to attract right number of employees. We insist. And at that time, the cash available in the company, for example, when Hyderabad Angels invest around 3 crores in a startup, 3 crores is not going to turn a bigger story. Please understand. So what we say is, for example, today, example I'll give you, there are many companies which came and said in enterprise SaaS, they're doing around $2,000 a month, $3,000. We call it as monthly recurring rate revenue. If MRR is 2 to 3,000, in order to raise pre-series A or a series A, he need to reach his MRR to $10,000 per month. If you want to raise a series A, you need to raise $1 lakh per annum, something, $1 lakh per month. To achieve that, the aggression what company need to do with this desired money, it is very impossible task if you need to attract right team and push it on the table. That's why we insist them to use ESOPs aggressively at these stages. At seeds, at angel investment stage, at pre-series A and series A, we insist to play an aggressive ESOP pool, because we want less cash go to employees, and this cash is used for the growth of the organization, either in digital marketing, either in growing the company, either to bring the company to next level. We wanted to use that cash there, where the cash is very, very small. Whereas in growth stages, as the company is growing, we wanted to reduce the ESOP. See, Satish Andhra, one of our India partners, he says aggressive cash play should come in growth stage. By the time a startup raises a series A or a B round, the business has grown. Founders should try to match the cash expectation of employees and restrict ESOP to those employees who are extremely valuable. See, he said, restrict ESOP to those employees who are extremely valuable. ESOP grants can go down and cash component should rise. ESOP should be offered to employees as reward. In the phase, the retention of outperforming employees become the key to the growth. At early stage, most of the employees may get ESOP, some amount of share. But once there is Series A or Series B, it is clearly an identification of the key growth drivers, what we are looking at today. Why we need to do? In the growth stage, founders should leverage ESOP to solve business problem. They should make right hires, and also founders should be careful with ESOP at this stage, as valuations are very high. Offer ESOPs when it is at most necessity. Understood, no? And mature stage Series B and above, startups are not allowed to grant ESOPs so easily. And if you are wanted to give ESOP, it is purely on performance based, nothing else. It is not anything at that level. The fair market values are really, really high. So they are saying that as the cash component is high, ESOPs need not be offered until absolute necessity. It is also important to know that in later stages, the value of the company is very high, meaning the fair market value for each ESOP would be very, very high. For this reason, founders should have balanced view of rewards that are being offered to employees for performance. In India, ESOP equity employees should purchase the shares, and the share price at that time will be 3 lakhs, 4 lakhs for each individual share. We got Ola shares when they were at $6 billion. Each share price is valuing around 60 lakhs. I think no employee can able to take that kind of cash to buy it. But we believe many unicorns are built on the foundation of strong and strategy of ESOP policy. Founders should understand ESOPs thoroughly and incorporate them for foster a positive work culture. So we have seen many founders failed in understanding ESOP. I've seen some founders who has good ideas. You'll say, okay, Ratnakar, you take 1%, you take 2%, you'll just give it off. I always say, if you don't value your own company and you are just giving off your ESOP shares, I will not invest in your company. It's very clear. If somebody is giving ESOPs without thinking just like that, this is not a company we need to invest at all. That is very clear mandate from our side. Yeah, I think this is what I would like to address on the ESOP portion is concerned. Any questions here?
No further questions on the chart. Okay, as we speak, there's one more question. ESOP pool creation to be created by issuing new shares or from promoter share?
ESOP pool should be done through creation of issuing new shares, not from promoter shares. We don't want promoter shares to be diluted. We want promoter shares to be held and issue new shares from the company.
So I have a question. So if a startup is about to raise funds from one of the angels, say, the ESOP pool is normally created before the issuance of shares to the new investor, or can it happen in the same round?
Generally, before investing, we'll ask them to create an ESOP pool. For example, today founder is holding 100 shares. We decided to keep additional 10 shares. It has become 110 shares.
Okay.
The founder shareholding will come to 90.9% and ESOP pool will be assumed 9.1%. I'm just giving you. Now I will go and take a 10% stake in the company. The 110 will become 120. Correct, no?
Yeah.
So I will have 121 AGM. I'm holding 122 shares. I will hold 10% share in the company. 9.1 will become 8.2% and 90.9 will become 80.2%. So the dilution will happen prorated. So we will insist people to create ESOP pools upfront before my investment, because if you do ESOP pool later my investment, my stake dilution will come down.
In the same round, if it happens, does that also impact the new investment? I mean, from your perspective, would that?
Yeah. That's the reason in the same round we can create ESOP pool. There is no issue actually. But generally they don't allow to create ESOP pool later. Generally we, at the round itself, we will push them to create an ESOP pool so that the percentage will have a positive impact. For example, in one of our startup, he created ESOP pool, additional ESOP pool at a Series A round.
Okay.
The impact for HA was 0.2%. You know what is 0.2% value? We lost as entire shareholders is almost 3.5 crores return for our shareholders.
I can imagine.
They all asked why Ratnakar, why we are allowing this, we don't want it to allow. There was a big fight. But finally founder was able to convince our people to try to compensate the loss of money through promoter shares. So we told him to issue shares for a promoter where we use the trust route today instead of diluting my stake. There are always fights like this actually.
Okay, got it. So we have one more question here. So can we draft an ESOP policy in early stage and issue ESOPs later?
Yeah, that's what we are insisting. You set aside the pool, ESOP pool, and you issue at whatever stage you are getting. That pool is available for you. That's
Okay.
what many companies does. Even as I said in one of the example, an employee got 100 shares assumed, and he has not opted to buy out. The 100 shares will come and sit in ESOP pool again, which you can issue to the new incoming employee if you want.
Mm-hmm.
If he is not availing that, exercising that option, it will automatically get terminated, and that shares will come and sit in our pool.
Okay. So can there be different categories of shares under ESOP with varying rights?
No, ESOP will not have any varying rights. ESOP will is from equity shares of the company.
Okay.
Only for investors, there are differential shares, preferential shares, CCPS, CCDs, all this will come only for investors who are putting in money.
Mm-hmm.
For employees, it is a plain equity which will come in play.
Okay.
Because law has not allowed to do some other transaction on these ESOPs. And they don't want you to play with employees. Please understand.
Mm-hmm. No.
So one of the key thing for ESOPs to be successful is the pool size. Yeah, you're saying something?
No, sir. You may go ahead.
Yeah, we are in last two slides, which I want to cover.
Okay.
See, one of the ESOP pool is successful if you believe that you are going to liquidate this ESOP at certain stage. I think you are listening in newspapers like Razorpay or Udan or Flipkart or Baiju. They're all helping the company employees to liquidate ESOPs and make money. But they are doing at certain level. They may be doing after series D, E, F, J somewhere. They're allowing this. You should keep in mind as a founder and able to execute.
Okay.
And fair market value is clearly a thing, and size of ESOP pool need to be decided. I see many founders, they don't know how to create ESOP pool. Is it 5%? Is it 10%? Is it 15%? Is it 25%? What investors are looking, please remember, most of our founders will say, by the time you raise Series A, means after you raise Series A, founder should hold a minimum of 51% to 60% stake. Then only you're a successful founder. Before raising it Series A itself, most of the founders have diluted stake below 60%. They are gone. They are not getting funded by the VCs. So that then they say they suddenly come and say, Ratnakar, we wanted to slide down on the ESOP pool and we wanted to bring it back. Then they see that founder has not taken a right decision and somewhere on his strategy he failed. So again, creating an ESOP pool is an art. So what people have said across industry is create a 10% of overall shares as a ESOP pool. They made it more standardized here. Because the 10% dilution is still okay at early level. As it grows, the dilution will come down. If needed, at higher valuation, promoter can decide what he can do for some incoming employees where he wanted to grant when ESOP pool is completely done. So founder should keep in mind, he should be able to give an exit for the ESOPs, which he has granted to the employees. He also should be aware what is his ESOP component, which he need to keep in mind. Today also I seen one founder saying that out of 10% share, he wanted to give 5% stake to 2 employees. And the company is valued to 50 crores. I asked one question, 2.5% on 250 crores is 6.25 crores. Are you willing to grant this kind of amount to your employees who may be paid a salary of 50 lakhs per year? And why you are betting so much, which investors will not like to do only for 2 employees. The pool is for a larger,
Mm-hmm.
they need to consider. Understood, no?
Understood, sir.
And ESOP pool, there is a question, mid-level employees, lot of people will not give until and unless he's an early stage employee. When company was in ideation stage, and this guy joined without any expectation, and he really worked hard with the founder, they will get, for example, 2000 shares or 3000 shares in the company, which is in percentage 0.001%, 0.002% is what they get for mid-level employees. Most of the ESOPs are targeted to CXO, CTO level, who are really helping company to grow to a multi-billion dollar company today. Most of the percentage will go. That's why in the Companies Act, if anybody is getting more than 1% share, again a special resolution need to be passed in the shareholders meeting. They're not allowing you to do that. So all the ESOP pool should be less than 1% given an opportunity.
Okay.
And somebody has asked, is ESOP advisable at staff recruitment stage or talent retention purpose? As I said from point number 1, it is for retention purpose. Though we compensate as a part of their salary, but it is clearly retention. We wanted to retain that employee for longer time and give us the desired result. There is a question, what are all the risks we should keep in mind while offering ESOP? ESOP is not a risk for you, sir, as a founder. It is only getting diluted. The risk is more for an employee. If the organization is not successful, whatever ESOPs you are given has no value in their hands because they will not be able to see any liquidity. If company is closing down, they don't see any money at the end of the day. The risk is more on the employee than on the company. Company risk is only dilution of their equity stake. A 10% after Series D is, for example, Baiju, which is $18 billion company, even they have an ESOP pool of 3% in 18 billion, just see what dilution founder has done. That is the risk which he is carrying today. There is a question, how do you value worth of ESOPs given in early team members? I said fair market value. There is no value as it grows, they also grow. What are the pros and cons of making ESOP policy more before any funding round when founders are only investors? Yes, when founders are only investors, still you need to create a pool. Use that ESOP in future whenever you're attracting people. And as I said, 10% is the standard which people are trying to offer today. What should the founders and CEO do? Keep ESOP pool going. Yes, ESOP pool can continue to grow. You cannot cancel in between. A lot of people discourage. You have an option to cancel, but again, you wanted to revive it back. It is a Herculean task. When a VC comes in or a PE comes in, it becomes a Herculean task to convince them to bring back, because even for them, a 0.01% dilution sometimes make them lose at least $100 million if the company grows really big. And I think I have answered few of them this thing. And finally, I wanted to say, being from VC world, I would like to advise founders again is creating full ESOP pool before the VC comes in with investment. Because so they are saying, VCs are saying create ESOP pool before investment comes in. And founders should be able to negotiate if he wanted to do more dilution, but it becomes very Herculean task at various levels of organization. Whatever he said here, our Satish and other people, it is not so easy, and it's not so easy in creating ESOP pool at later stage after Series A or a Series B. A lot of people will fight. So these are the few points. Please I am still open to spend another 5-10 minutes if anybody has any questions.
Hello, sir. I just asked you that question regarding creating of ESOP pools, the new shares or promoter shares. Okay. So my investor is insisting on promoter shares. And the reason being told is if after the valuation is done, the value of a share is fixed. If you increase the number of shares, the value of the share reduces. It is a loss for the existing shareholders.
That's
For that reason,
So
for that reason, they wanted a promoter to dilute their own shares.
Correct. That's what most of the companies are allowing. Guru Vignesh has asked, what is advisory stock option? How it is different from ESOP? See, today, many of the startups to grow, they're bringing advisors on the platform. And what we are saying, if somebody has created an ESOP of 10% in the company, we are saying allocate some portion of that shares as an advisory stake. Advisory stake is nothing but, for example, an advisor who comes and spend time, you need to pay 10 lakhs or 20 lakhs. Instead of making the payment, you will give him as a shares. It is like an employee stock purchase plan. You will ask him to buy the shares of so and so value instead of giving money to him. They were called as advisory stakes. They, as per the VC world or an angel networks, the advisor should deliver what founder is looking and what they're expected to for the desired outcomes. So we have seen some startups giving advisory stake letters, but when VC come in, we are not seeing the desired result for them. Most of them, this advisory shares letters has been cancelled. And there were a lot of fights in these cases actually. So I want founders, as a senior guy coming in helping you is very, very important. But you decide how they bring value to you. Most of the people you think can bring value, what I observed, but it was not able to give the desired benefits, and VCs have really put hard on the startup founders. Vignesh, any question for you? You raised the hand before we go to Geeta.
Yes, sir. Hello, sir. I'm Guru Vignesh. Yeah. So I just want to know about this advisory stock option. And one more point is like, is it getting allocated from the ESOP that I have allocated already, or is it a separate allocation that we need to make? And is there any, as you said, we need to give when the advisor's target or whatever it is, if it is not achieved, it is like they can't, they don't have an option to convert it as a shares. So is it my understanding right? Or yes, how it is drafted now?
Guru, this is a very sensitive question, very difficult to address. For example, I'm just putting an example. Ratan Tata will join the board of your company. Because he is joining the board of the company, the total startup is getting elated. And you decided to give 1% of the company's stake as a Guru Dakshina, which I call it, this thing, as an advisory stock option. You need to give. There is no question, nobody will ask. But there is some professor in IIT who is doing better, and you need his help either to build your particular product, your particular paradigm, which is going to fine-tune your product or a service, and you feel he is bringing a lot of value. You want to give an advisory stock, you can still give it. We have seen many mentors, especially, not to quote, many of the accelerators or incubators have many mentors saying that we will help you this, we will help you that, we'll get you the business connect, we'll do this, we'll do that. There they are seeking an advisory stake. So what we said here is the startup founder and mentor should do a journey for 6 months. And the startup founder feels that he's bringing the desired value to him. Then only we said, give the advisory stake with certain milestone what you wanted to achieve. Just by bringing one business proposition to you is not going to change the startup phase. We want more business associations to come in play. So we were telling that a lot of people were unhappy, but we were pushing on this side. Don't give ESOP because you need to value your own company. As I said, if the company valuation goes to 300 crores, a 0.5% on 300 crores, you are already giving 1.5 crores to that guy just by losing out that money. So please think before giving advisory stake, what percentage and what value you are giving and how you are controlling. Are you able to get the desired benefit? And these are the people who sometimes I also personally feel they pull down the companies to a larger extent in terms of stake dilution.
Okay, sir. Yeah, thank you.
You need to be cautious. You need to be very judgmental, Guru Vignesh.
Yeah, okay, sir.
So Geeta Krishnan has asked how many employees typically get ESOPs, number or percentage. You will decide percentage of ESOP pool. In that, you will give a number in the ESOP letter. Number of employees at early stage, I am okay even if you're giving to everybody. But as you go in later stage, it is restricted to the top management of the organization. So be careful when you're issuing shares. Except Narayan Murthy, which we heard Infosys, that his driver also became a millionaire who has got the ESOP pool from Infosys. That's a very, very rare incidences. But I am saying be careful in issuing the ESOP to employees. How do you issue? Because a lot of startups start with 1 lakh shares of 10 rupees each of 10 lakhs. They have a pool of another 10,000 shares. They create it by passing a resolution. In 10,000 shares, how many shares you want to allocate, and some portion of the shares you need to keep for your future acquisition of the this thing. So we insist currently in this round, if you wanted to issue ESOP, restrict it to 3 or 4% of the total available shares. For example, you want to give only 3,000 or 4,000 shares, keep 6,000 shares for future requirement. As we know, each stage of growth, you need to attract larger people at CXO, CTO level and use at that point of time. Don't issue all 10,000 shares and just hold hands. You are done as a founder. Don't worry, it is too less or too heavy. I see many employees saying, sir, what is 300 shares for me? What is 200 shares for me? I said, you guys are fool actually. The company today having 1 lakh shares, in that you are getting 200 shares is a great value proposition, and company has been valued at certain level. Don't undermine the company, because a lot of people are not able to put 1 crore or a 10 crore share worth of capital in the initial stages. No founder is doing that actually. The max they are doing is 5 lakhs, 7 lakhs, 10 lakhs. And today we have one company called Planet Spark. The total number of shares they hold equity is 2 lakhs 10,000 shares, and company has been valued 950 crores. In that, in 2 lakhs 50,000 shares, even a 250 shares employee is holding on 950 crores, you just assume what kind of money is making today. So tell employees, don't look at number, the value what that share is doing is very important in your growth story.
I think you've covered a very comprehensive part of the ESOPs as a topic for discussion, and we thank you so much, sir, for being part of our startup initiatives, and we are extremely grateful for your time and efforts. And it was a very informative session and a much needed topic for discussion, considering the how pivotal ESOPs play in retaining talent and building the company. And as a token of appreciation on behalf of the incubation cell, we would like to send you a gift, and we shall reach out to you on that separately. And we hope to have you on more such informative sessions in the coming months. Thank you so much, sir.